Last week, investors sold the equivalent of $11.73 billion in U.S. stocks, an absolutely massive outflow from the U.S. stock market as many investors are bracing for an incoming recession in the United States. And indeed, in the same week, a major economic indicator called the ISM PMI showed that new orders in manufacturing are beginning to enter a more severe contraction. Since the month of January, we've seen this indicator show a rollover in economic activity, which many are extrapolating and concluding that the U.S. economy will be in a full-blown economic recession in a matter of months. Because if the ISM PMI were to just move a little bit lower, we would quickly enter a zone that is typically associated with U.S. economic recessions. And as most investors know, economic recessions are typically not such a good thing for the stock market, with U.S. stocks on average declining by around 30% in the average recession. And of course, financial media outlets have been rushing in to feed into this investor panic, likely pushing many investors out of the market. And indeed, since July of 2024, the stock market has been particularly volatile, making many investors flip bearish and expect a much larger market correction. But when we zoom out a little bit, the stock market isn't at all in a technical structure that mirrors these types of concerns. For all intents and purposes, the stock market is just a few percentage points below its all-time high, with many indices like the RSP, which is the equal-weighted version of the S&P 500, making a brand new all-time high just a couple of weeks ago. When we rewind to October of 2007, just a couple of months before the onset of the 2008 recession, we see that this index, the RSP, was not making new all-time highs and was even beginning to break down below all of its key moving averages. By the time the recession hit in 2008, the moving averages were curling downwards. That is, of course, a substantially different picture to what we have today. So if you're making a call today on a big bear market being triggered by a recession over the next few months, we would need to see a lot more deterioration in economic data in order for price to continue moving in that direction. So let's take a look at that. But first, make sure to take advantage of the discount that we're doing on our subscription service. The Fed is cutting interest rates this month, and so we thought it would be fun to also cut prices on our subscription. Our mission is to help as many people as possible become successful in markets, to learn how they operate and adopt the right mindset to become profitable. If you're serious about trading, or you're even just developing an interest in trading, I strongly recommend you take advantage of this discount. One key concern for investors recently has been the deterioration in U.S. job market data. And indeed, if more people are losing their jobs, more people are likely to cut back on spending, and that's likely to lead to lower earnings for U.S. stocks. One key data set for the U.S. job market is non-farm payrolls. This is basically a chart that shows us the number of jobs that are created each month in the United States. And indeed, currently, job growth is at the lowest level since the pandemic. So we currently have a job market that's a lot weaker than anything we've seen over the last 4 years. Now, this is something that we've been talking about with our members for over a year now. Our expectation has been that the job market is likely to cool down and continue cooling down until the U.S. eventually hits a recession. But although that's been the case for the last couple of years, the U.S. economy never entered a recession during this period. So the question now is whether the most recent data is suggesting that we are finally entering a recession and that investors dumping stocks today are right to panic out of the market. Now, when we zoom out a little bit to take a look at the 4 previous economic downturns in the U.S., we see that all of them get triggered when non-farm payroll reports dip into negative territory. That means instead of the U.S. economy adding jobs, it's actually seeing negative job growth. And when that happens, that's when you can actually see some pretty big damage in U.S. stocks. So if you've been wondering why the U.S. stock market is still making new all-time highs, despite all of this news that we're seeing from financial outlets regarding a recession, it's because this data is not recessionary. Now, of course, this chart could morph into something like this. In fact, we've explained why we think that's eventually going to happen. But from a trading and investing standpoint, it's still too early for us to act on this data for now. Investors who panicked out of the market in any of these slight dips in non-farm payrolls would have been left out of a massive bull market. The reality is that right now, although job growth is not very strong, the U.S. economy is still adding jobs. And when we look at a chart of total U.S. payrolls overlaid against a chart of S&P 500 earnings, we see that they're pretty much a mirror image of one another. And so if the US economy is still adding jobs, but maybe at a slower rate, that would still mean that S&P 500 earnings would climb higher. So at gameoftrades.net, we've used both of these market corrections as an opportunity to add new trades. Now, don't get me wrong, there are reasons to be concerned about the market in the near term. August and September are both seasonally very weak months, but overall the macro data and technical structures are not making us extremely worried. In fact, the Fed cutting interest rates could temporarily cool down these market fears and lead to another rally. We are closely watching the charts at gameoftrades.net, keeping our members on the right side of the trend, and also having many bets that protect us and diversify us in the event for when the economy does begin to roll over. We teach you the mindset, the rules, the strategy, everything that you need to know in order to master the market. If you're serious about trading, make sure to go to our website and grab yourself a subscription.